let's bring in our panel here. Euro-Pacific Capital Chief Economist and Global Strategist Peter Schiff and Nat Alliance Securities Andy Brenner. Andy, you sat here the last meeting and said that's going to be the last hike. Okay, we're not here to make anybody, squirm, but why did he raise and not pause this time?
Liz, he was concerned about the message he was saying. I think he made a huge mistake. There's no question the banking system's in terrible disarray, and it's just going to get worse. The negative arbitrage between going to Treasury bills at 4.80 or money funds at 4.5 and banks paying 1 to 2%. Banks are going to continue to lose money and lose deposits. It's just going to get worse and worse and worse. And he did say that 6 banks are in trouble, or he used some kind of specific Fed verbiage to say that. So I think the banking system's going to get a lot worse, which is why you saw the 2-year yield go from 4.25 around noon to 4.125 when you just said it as you spoke, down to 3.95, and I think that's going to continue to happen. And you saw the 2-10 yield curve right at the beginning go to minus 63, and then last I looked on my phone here was minus 46. So I think that tells you that steepening move that we're seeing tells you that there's a lot of problems out there, and the Fed's going to have to ease, and the markets do not believe that the banking system is solved.
And yet, Peter, he said 10 times, because I got my producer Finley Walker counting. Oh, now it's 12, Finley? Okay, 12 times he said that our inflation target is 2%. We're hovering around 6%. Are we going to get to 2%? Because he certainly insisted that they are going to keep raising rates until we get to that point.
No, we're not going to get anywhere near 2%, maybe not even in our lifetimes. That's how far off Powell is. The reason that he hiked rates, he's borrowing a trick from a magician. It's called misdirection. Because with the one hand, he's raising rates, but he's got another hand behind his back where he's just returned to quantitative easing. He's actually creating inflation. He's not fighting it. And I thought one of the most ridiculous comments he made is when he was kind of asked to explain that. And Powell denied that the Fed was back to quantitative easing. And the reason he said that it's not QE is his explanation was when the Fed was printing money and buying bonds because it wanted to bring interest rates down, that was QE. But now it's printing money and buying bonds, but it's doing it for a different reason. So even though it's exactly the same, it's not QE. So when you create inflation because you want to, it's quantitative easing. But when you create inflation because you have to, then I guess, he pretends he's not doing it. But he is creating inflation. And so what Powell is now doing is pouring gasoline on a fire. He's just pretending that he's trying to put it out.
And I would think that the embers, if not more flames, are starting to grow here. And I only say that, Andy, because we're looking suddenly at Comerica. Comerica's in trouble right now. Those shares are down. I will say the S&P's turned positive, as has the NASDAQ. Russell's still down. Dow Jones Industrial still down, but way off session lows. Remember, the Dow was down 271. It's down 39 points right now. But, Andy, you just pointed out that he said 6 banks he believed were really kind of floundering or under siege. But I do want to play this one particular soundbite. He said that we have the vice chair of the Federal Reserve, Michael Barr, who is going to appear before Congress this week or next week to give a review of what's going on. But the Fed appears to have been asleep at the wheel with Silicon Valley Bank. And he also downplayed that there was any contagion. Listen to what he said.
I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk.
An outlier. Signature Bank no longer exists because it collapsed after SVB. Andy, and where's Credit Suisse today? It had to be bought in a shotgun wedding by UBS.
Well, Liz, I'm not going to go to the Credit Suisse thing because that's a whole different venue. But here in the United States, regional banks are under severe trouble. SVB, you had Signature. I mean, the Fed last week had to put $440 billion into the system. The Home Loan Bank put another $300 billion. Liz, basically that's effectively wiping out the whole QT that they've done in the last 11 months. And it's going to get worse, worse, and worse. I was scanning the headlines today, and you have West Bank had to get some outside sources of money. They've lost 20% of their deposits. And as you go on, you mentioned Comerica. I'm telling you that this is mushrooming. We need to lower rates 100 basis points. Forget about inflation for the moment. The expectation.
You just say 100 basis points?
100 basis points. We need to get to 3 to 3.5 in order to stop the bleeding in the banking system. All right, that's what we need to do. And Powell's not ready to do that. He's not ready to think about that. But, that's what he really needs to do. So, yeah, as far as what do I think I think this, again, is the last Fed hike in this cycle. But we'll have to wait. If we get 6% inflation numbers, then he's going to try to do it again. It won't work.
Peter.
Well, I agree. I think this is the pivot. I mean, it's a soft pivot, but he made it clear that he eased his forward guidance. So I think the next move from the Fed is going to be a cut. But inflation is going to be much higher than it is right now when the Fed does that. So the Fed is going to have to give up this pretense that it ever has a chance of bringing inflation down. I thought one of the most foolish comments that Powell made is he said that he didn't think there was any risk to the Fed in these swaps that they're doing with the banks.
Oh, right.
Well, because he said the FDIC is insuring the banks. But the FDIC is broke. They don't have any money. The only way they're going to get money is if the Fed prints it. So all of this means more inflation.
I absolutely agree. But it also calls for oversight, which we were supposed to already have, Andy. And in fact, we know that Mary Daly of the San Francisco Fed, it was on her watch, right? Isn't she the one who was supposed to have her offices be regulating those banks in California?
Well, Signature's here in New York, but SVB, absolutely.
SVB, yeah.
And they were in there. They were looking at SVB. They had recognized there was a problem, but they didn't do anything about it. And there were so many better ways for SVB that they could have lent their portfolio over to the Fed. But once they sold their portfolio to Goldman Sachs and took that multi-billion-dollar loss, all right, that alerted everyone. And Goldman said, well, we'll sell your stock for $200 a share. It was trading at $269. The next thing you know, it's $106, and the next morning it's $38. And now no more SVB.
Okay, that's called a bank under siege.
Yeah,
and
Liz, you're never going to get effective regulation by the government. What we want is free market regulation. Unfortunately, we don't have that. This financial crisis has been obvious for years. Only government regulators are blind enough to miss it. But if the government wasn't there, if banks and their depositors, more importantly, realized that their money was at risk, if a bank failed, then banks would be acting a lot more responsibly because people would not deposit their hard-earned money into a bank that was taking too much risk.
Yeah,
but thanks to the government, no one cares.
And speaking of deposits, the FDIC insured everybody's in both Signature and Silicon Valley Bank. And now there is word that they may have to take on all depositors who have more than $250,000, which is that limit at the moment. Our Grady Trimble actually caught up just a few hours ago with Senator Liz Warren in the hallway. She's on the Senate Finance Committee. And you got to hear what she says about oversight. Listen.
There's got to be a cap somewhere. Somebody can't, quote, deposit $1 billion, get a special deal from the bank, and still get backed up by taxpayers that they'll get their money back if the bank fails. That's not going to cut it.
I don't understand why Janet Yellen, the Treasury Secretary, is saying no taxpayer dollars will be used to insure everybody.
Liz, this is the same.
Liz, that's just politics. Yeah, that's just politics, but it's not really going to be taxpayer dollars. It's going to be inflation. See, every American, whether they pay taxes or not, is going to bear the cost of these bank bailouts and this new financial crisis that's
we don't
worse
have
than
enough
2008
money.
with
Look on
higher
the screen,
inflation.
Peter.
Well, just
the
print it.
FDIC has $128 billion in its coffers right now.
They
this
have
would
nothing.
cost $17 trillion.
They have nothing. The Fed is going to print it. The Fed's balance sheet is going to explode. And the value of the dollar is going to implode. And the cost of living in the United States is going to double. It's going to triple. It's going to quadruple. And it's going to impoverish the vast majority of Americans. And they need to know the reason they're going to be so poor is because of the government. It's not because of the free market, because we don't have one. It's because of this big government. And Powell copped out when somebody asked him, you know, what about would you need some help from fiscal policy? And he says, well, we don't want to give any fiscal policy advice. That's BS. He should be giving advice when he knows the government is creating inflation by running these huge deficits. It's up to Powell to tell the government to stop doing that, to cut government spending. But he refuses to stand up for the American public. He doesn't really want to do his job. He's kowtowing to the Biden administration.
Let me get in here because, Andy, the markets don't really seem to mind at the moment about anything that is sort of dripping fear over all of us here. We've got the Dow down about 67. The S&P is up 2. The NASDAQ is up 39. Russell's down 17. And the volatility index is not showing any signs of distress whatsoever. It's down 4.7%. What's the trade?
Here it is, Liz. On one side, you have regional banks, and they're going to stop their lending. They're going to cut down their lending. It's going to hurt commercial mortgages. It's going to hurt small companies, small cities. And on the other hand, the Fed's going to have to respond by lowering rates. So the market realized now that rates have to come down. And whether Peter's right or not, he's right on certainly a lot of things. The Fed itself has lost $1.1 trillion in their holdings just because of the way interest rates have gone. But I think the Fed's eventually going to lower rates, and I think that's what equity markets are betting on right now.
Well, the home builders are up. How about that? We got all the home builders in the green. Peter, Andy, thank you so much.